Sometimes you wonder, you have done a very nice analysis over there, you have used your indicators, you have drawn good trend lines over there, and the market is actually touching them very clearly over there. The market is moving so well, and you're very sure the market is actually going to go to your direction. But maybe after sometimes, maybe around 3:30, after 5 hours, then maybe you closed your trend, not closing your trend, you left your trends running, and maybe you are waiting for the profit actually to close over there. But when you just go back, you meet actually your account has just been blown up. The reason being is maybe you have been ignoring what we're just going to be talking about in this video. So in this video, we're just going to be talking about the fundamental analysis, and how I'm going to explain this. I'm going to explain it in a very easy language so that you're going to understand. If you're a beginner in fundamental analysis, don't worry, because I'm going to explain in a very easy language that you can just understand over there. I'm going to be taking you step by step of what you can translate this. Actually, this class is going to be very long, so make sure that you have a cup of coffee over there, or just maybe some water, and then you're just going to be writing this down. I have a notebook because this is going to be amazing over here. I'm going to be writing down so that you can just be following this. Without talking so much, why don't we start this class right after the intro of this video. Hello and welcome back again. So if this is your first time to be over here, my name is Dan, and this is Dan Tech channel. So we just do over here Forex trading, making money online, and today fundamental analysis is going to be very amazing over here. So make sure that you subscribe, like this video. If at the end maybe you like my content over there, there's somewhere you click thanks, you can just do that, and it's just going to be of help to our side over there. Now I'm going to be interacting this because there are some people who have been checking news, and sometimes it can just get confusing to so many people who don't know how actually to translate this news, or now you can just affect your trend. But there's something I just want to show you over here of what. Let me just show you what the news can just do over here, so that you don't have to fear the news. Actually, it has to be your friend. News has to be your friend, so you don't have to be worried. Sometimes people think I'm not going even to train these things, so news can be your friend. Okay, now if you can see over here, we have this NFP data release, and you can see what happened. Actually, these are very big move over here, okay, that happened to the dollar index. This movement over here, okay, these are very big movement that happens. So that you can see there's a very big move over here on the dollar index. If it actually can just move like that, if maybe you end open position that was from buy over there, then I think your account is either going to be blown up, or you're going to have a very huge loss that will take time for you to recover that. So that is just one of the FP news. We have interest rate, we have a lot of things that actually can just move the market to move in that direction. Let's start over here, and I'm going to be analyzing this, so I'm going to be writing over here. So let me start over here by writing the word fundamental analysis as you write on your side, okay, as you write on your side. So I'm going to divide this session into two. So this is the first one, and then you'll just be having the second one that will just be learning a lot. Now we have two things over here. We have actually four things that we can just talk about over here, and we start by what we call the economic indicators. Economic indicators. So we have these called economic indicators that you actually see on the market. Then we have something we call trend developments. Okay, trend development. These are the things we check on the fundamental analysis. Then we have what we call geopolitical events. Geopolitical event. Okay, so I can just talk about these three, and the final one, we have what we call monetary policy. The reason I've talked about the monetary policy, because this monetary policy actually can just come at the end of all these things after happening. Then we can just have the monetary policy. So that is amazing over here. So I just want you to follow this because it's just going to be amazing. So we have economic indicators, trade development, geopolitical event, and monetary policy over here. You know, like the way we have economic indicators over here, like we have technical indicators, then still we have economical indicators, and then that is what we are going to be discussing right over here. Now let's start with this. We have number 1 here, number 2, number 3, and number 4. So the moment actually you at least understand those things over here, then things are going to be amazing right over here. Now let's start with what we call the fundamental. So fundamental analysis actually comprises between, you can combine between what happens on the geopolitical, or that like something like news plus political event. You know, geopolitical can be all those things. We have trend development, okay, like countries between countries. You know, we have monetary policy that the government takes. I'm just talking so that you can understand where we are going, you know, something just like that. So first of all, I just want to start with what we call economic indicators. So that is what is going to be our first things over here, and actually the rest are going to be simple. But on the economic indicators, that's where we have a lot of things to talk about over here. Okay, so I'm going number 1 to talk about the economic indicators. So as a trader, you have to be knowing the major economic indicators that are there. Economic indicators, okay, and finally we'll end with the rest plus the monetary policy that is actually taken by the government over there. Okay, so let's start over here. I'll be taking you slowly over here until you just get all things over here. Now when it comes to economic indicators, what does it mean? Economic indicators, as the word suggests, is the economy, is how the economy is performing. You know, indicator is something that can show you how something is performing. You know, on the technical analysis, we can have those indicators that show us the price is overbought, this thing is moving this way, when it crosses this way. So those are the indicators. It just shows you how something has just performed, and it will show you when something has eaten what you expected, something like just like that. So over here is not about technical analysis, we are talking about the economy indicator. So this will just tell us how the economy is actually doing over there. Okay, and let me just give you an example over here as we just start on this one. Okay, let's start with the simplest one over here, where we can just call this A, okay, and we call this something which there's actually the one that causes the that is the market to move over here. All of these, the ones I'm going to discuss over here, they are the major ones. Actually, I'm going to be around 5 of them, and that's why we have these 5 major economic indicators that you have to know as the trader. Let me even start with what we call the GDP. So what is GDP? GDP means gross domestic product. Okay, so this economic growth, okay, this GDP, as the one suggests over here, okay, this is gross domestic product. So you can see GDP over here. Domestic means what? Domestic means something of that country, domestic of that country. Okay, GDP means of that currency over there, that of gross domestic product. GDP, domestic, something that is internalized, that of country, of that citizenship, okay, of that people who are living in that country. So that's why we have the gross domestic product over there. Now when it comes to GDP over here, sometimes you can see those news printed on the Forex calendar right over there, and you see something like GDP printed out. How is it going to that is affect your currency pairs over there, the pair, the currency over there, either dollar, euro, GBP over there. So let me just talk about the GDP. Okay, so GDP can actually cause these two things over here. Let me just explain, because sometimes it can just be confusing to some people. Let me explain two scenarios over here that can happen with GDP. Okay, so when economy, so this actually shows us that the economy is actually expanding. You know, the economy is expanding if you have a very high GDP. That means the economy is what? Economy is just doing so nicely over here. So when we have a growth in GDP, then we actually know the economy is doing good. So when we have the high GDP, when we have high GDP over here, then we know the economy is growing so nicely. And what can this GDP means over here? Okay, when the GDP is growing, that means like we can have something like investors coming to invest in that currency. The demand for that currency, for example, I'm going to be using US in this matter. So we have so many people interested maybe in investing in the US dollar. We have so many investors loving to invest in the US, you know, because their economy is actually growing. So that means when the GDP is actually going higher, then we expect the strength of currency to just go higher. So you can say the GDP is actually directly proportional to the strength of the currency. But I think there are two cases that GDP can cause over here, and I don't want you to confused by that. Okay, so the GDP of that country is actually going up, is making higher. So that means we have where that currency is strengthening. Okay, so we have investors and all those people. Okay, now note this: when the GDP grows so fast, I mean, for example, there's how the government can see this GDP is just going with time slowly, but when it actually grows faster and more, okay, so it makes people to have more money. You know, when this gross domestic product is growing and people are producing more, the producers are getting more money, you know, something like that, then it will cause people to have a lot of money, and now it can cause something we call the inflation. So when there's inflation, when the inflation actually comes to high, we just come to the CPI, it increases the CPI, then the CPI actually will cause the government to have what we call the monetary policy, and they can actually come to implement something we call the interest rate, which actually is negative. So high, very high, so high or growing, we can just call this growing GDP is positive, but very high GDP will cause a negative impact, okay, because it will cause inflation. But when we have a growing one, it is going to be positive because people are going to invest in that currency, economy is going to grow, and a lot of people are going maybe to invest in that currency. The demand of that currency on that nation is just going to go higher. So that is how GDP, you can just check and how you can just translate on that. So that is what we call the GDP. So if you can actually understand this, and maybe when you see those news happening over there, maybe on the Forex calendar, then you see actually printing either green or red, that is when you know that it is yes high, it is yes low, but it is positive or negative. When it is very high, you know, yes, it is increasing, but this is right, okay. But sometimes when it's just growing slowly over here, it actually becomes positive. Okay, I hope we are now there. So that is one of the economic indicators. So you can see how it indicates how the economy is just performing right over there. Now we have number 2 over here. Okay, one of the indicators right over here, and the simplest one is what we call the unemployment rate. So most of the time when you just go to the calendar over there, you see something written like unemployment. So when we talk about the employment over here, so when we talk about the unemployment, rate over here, we are talking about the number of people who are actually don't have the job over here. And actually you always know when there is high employment rate, when there is high employment rate, people normally don't have the money. People don't have the money. And what does this cost? So what this cost is over here, let me draw something over here, a circle. So we have low, high, we have high unemployment. So we have high employment over here. So what high employment will cost here? Will it cause the economy to contract or expand? So it will cause the economy to do what? It will cause the economy to economy to contract. Okay, economy contraction over here. So the economy will actually contract over here. At the moment we just have the economy contracting over here, so what the government will do is just come up with the policies. So there are many policies that government can just come over here. I'm just going to give you in this case something like of the interest rate. That is one we are going to be using over here. So what will happen over here, it will now try to come up with something that actually can expand this economy, because so many people don't have the job. But when you talk something about the interest rate over here, like the policy of interest rate over there, the government actually will just decide, the Fed will just decide to cut the interest rate so that the economy can actually expand. So expansion. So you can see the economy is going to expand. So once the economy actually expands here, economy expands, and when it expands more, it will cause something like unemployment, it will cause high inflation again, and then it will just be a cycle of making sure that the economy is stable. So that's how everything. But you always know that high employment rate will cause an attractiveness of that currency. Okay, so higher employment, the lower the strength of the currency. So they are inversely proportional right over here. So when there is high unemployment, then there is low strength of the currency. It's the same as employment rate. We come to that. So when there is high employment rate, there is the strength of the currency. There is the strength of the currency, but not also this one. When there is very, very high employment rate also, okay, when the country actually prints the number of employment rate consecutively all the time positive, then a lot of people are going to be having money, and then they're going to spend in the economy, causing the inflation. So when you can see that actually there is a positive printing of employment every month consecutively, then you actually know there's something going to be caused on the inflation, and actually the inflation is actually going to be coming very high. We've been talking about the CPI in data. Let's talk about the inflation, which is CPI, which is consumer price index, known as the CPI. So this is consumer price index, the CPI. Okay, so this CPI actually will just measure the value of the product in the previous. For example, let's say the price of the brand was going at let's see something which something can just go at 100. Okay, let's assume the price of a phone is last year was $100. Okay, so the price of a phone last year was $100, but this year the phone is costing $1,000. So our inflation is actually measured is this one. So you just compare the result of the last year plus this year, and then you just this is 100 divided by 1,000 times 100. Okay, so 2 okay, 1 okay, no, not this. I think, how do we calculate inflation? CPI, is it the last one or the first one? So the inflation is actually that is cost of market buckets in the current. Yeah, okay, yeah, so this is the current one, which is $1,000. So that is not 10%, divided by 100, okay, times 100. So you can see actually it has grown by 1,000%. So this is very high, because you can see the cost last year was this, and now it is this one. So you can see now the inflation is actually very, very, very high, and that is now where the problem is. So what the government will just try to do is to make sure that they regulate this one. No, this is what I'm just give you an example of the CPI. So this is our that thing that you're just going to be talking about over here, the CPI. So you can see something like an employment rate. We have talked about the GDP. All of them, they can actually cause the CPI, the inflation data, to come over there. And these are the economic indicators. Don't forget, we call CPI data that is calculated between, if you wanted to calculate the CPI, you can just go by dividing cost of the market or the bucket in the current period, divide the cost of bucket in the base period. Okay, so and you multiply times 100, and then you're just going to get the percentage over there. Okay, and you're going to be getting over percent. So if it's above 100, something like that, there's how they measure this to know it's just the excess. You can just go and get those calculations over there, and then that is the CPI. So if the CPI is very high over there, there's how, for example, you just go to the calendar over there, you can see the CPI in data. There's how CPI. Let me just define those types of the CPI data we have. Let me show you the types of CPI so that I can just explain this. We have the CPI that are shown on the calendar, so you have to be knowing on the CPI that you have to be checking right over here. Okay, let me show you here. So this is the calendar. Let me just find the CPI in data. So we have the CPI MM. So CPI MM, as you can see, let me expand this. So we have this, you can see like of this or 330 on Wednesday, we have this CPI. We have these three of them. So CPI MM means that is CPI data compared to month. So if there's something that actually was coming to a certain price last month, then they have to compare it with this month to see how that things have been performing. If the price of a product, and then they just to see how is that product been performing in the every month. Then we have CPI YY, that is means that is the CPI of the product last year and the CPI of product this year. So that is why I count yearly, and this is monthly. Okay, and then we have the USD, where we have the core CPI. So this is the CPI excluding the food and energy. So as you can see over here, food and energy prices account for the about a quarter of CPI, but they tend to be very volatile and discount underlying the trend. The Federal Open Market Committee usually pay attention to the core data so the trender. So this is the CPI as of excluding those data, that is called CPI right over here. So when it comes to inflation over here, you can focus on the CPI YY and the core CPI right over there. That is what you just be checking around that area. So as you can see right over here on the CPI YY, that is CPI yearly, we expect the inflation actually to be coming down on the here, like we have last previous one was 4.0 and now we expect 3.1. The last one on the core CPI was 0.4 and now we expect 0.3, and that means that the inflation is actually coming down right over here. Okay, so if it is print below 3, that is when we know the inflation actually are coming so down. And what will just happen to the market is that now what we expect over there, like in terms of the policy, is the government now to that is reduce they reduce the cut of the interest rate over there. Okay, so this CPI means that if the product actually was costing something like the one we used right over here, 100 last year was something like $100 and this time is 1,000, that means it is actually reduced maybe to $800, and then that is a positive thing to the government. But when it's actually very low, then it is banned for the currency. So that's why you're seeing maybe if it prints below 3.0 or below 3.1, then it's just going to have band impact over there to the currency pair. So that is the CPI. So those are the economic indicators that you can just use over there. But we cannot finish this without talking the major one, which is NFP. Okay, so this NFP means that is non-farm payroll. Okay, non-farm payroll. Okay, now when we talk about non-farm payroll, okay, we are just talking about something like employment excluding the farms and the private sector and non-profit that is non-profitable farms over there, sectors over there, that is private sectors. So when we have this one, actually it causes the market to move so well. So this causes the market to move so fast, and this is one of the things that traders actually do follow so much over here, the NFP. So if you are trader of the NFP over here, sometimes you have seen when I was starting, I just show you how NFP actually causes the market to move so fast. The market moves so much by NFP right over here. So NFP is one of the things that causes the market, like this you can see, is a very number one of the first indicator that causes volatility either in all the currencies, especially on the dollar and all these. So those are the ones that can cause the market. So talking about the NFP, what I can just say about this, when there is increase, when there is high NFP data that has been printed on the market, then actually people tend to okay, when so many people actually are employed, high NFP, INFP, when so many people are just employed over here in the market, then we have so many people earning money. People are earning a lot. So if people are earning a lot, then they tend to use that money a lot. Everyone wanna ask money. When everyone asks money, then you always know that there is high spending. People will spend more because they have money, and this is one of the things that actually can increase the inflation data, something about the inflation right over here. And sometimes you'll be asking, is it all about the CPI and all that? No, because there are other factors that we're just going to be talking over here. We are still on the economic indicators. Remember that we are on the economic indicators, and this is number 5. This is number 4 or number 5, okay? But this is one of it that you have to know right over there. NFP, okay? When there's high NFP, just know people are going to be earning a lot. And also just remember that also low NFP over here will just cause the market actually to the slowing down. Now, what do you see on the FXP right over here? Let me show you what happened last week, and probably you just understand what I'm just talking about over here to avoid more confusion. So on Friday, let me just go. I'm not going to say on Friday because maybe probably you are watching this video before that. So you can see we have what we call this data is known as non-farm employment change, that is NFP over here, non-farm employment change. Previously it was 306, okay? Previously it was 306, and now we have 209 right over here. So those means that some people have actually lost their job, and is the last year we had 306 and now it is 209, which means that so many people have lost their job. They don't have money to spend over there. And we're saying something about the employment. When there is no employment, the strength of the currency actually tend to be negative right over here. For example, you can see something like this. We have the employment coming from negative 13.37, and now it printed 59.9k, and now this is a positive one. That's why it is in green. So that is employment change in Canada. You can see it was positive because it printed high employment rate. But on the NFP over here on the US, you can see the employment the NFP actually was low, 209,000 over here, which means that we saw little amount of jobs that were printed over there, and that made it to be a negative towards the economy. But sometimes when we can have a positive one and can cause the market to go up when we have a lot of them. But as I said, if the market actually will print consecutively high NFPs over there, then it means so many people just get employed over there and they will have money causing the inflation. So very high will just cause the market will cause the currency actually to have those fear sentiment, and can cause the market, the currency, to weaken right over there. Okay, now as you can see now on the USD over here, how do you know that something is just going to happen right over here? For example, on the UNFP over here, the prediction was 224. So already there was analysis that was done, and the market actually the NFP was actually to come down. So we expected the dollar actually to just either have a negative impact over here on the NFP side over here in terms of the NFP over there. So although it's not accurate, but that is what was expected, and actually it printed 209, which was far from 224 predictions over here. But after all, you expected low NFP right over there. Okay, yeah, so that is something that you can see right over there. So those are the economic indicators that you can just use over there, how they can just move into the market. Now the last part that we are going to be talking about over here is what we call the we have the other like political event. Okay, so this is number 2. So number 2 is what we call geopolitical geopolitical event. Okay, now when we have these things called geopolitical event, this can be, of course, a lot of things. When we come to geopolitical event, of course, we can talk something like politics. So when we talk about the politics right over here, politics can be something like this. For example, when there is a political unrest, you know, when there is chaos, when there is something that happening in a nation because of politics and something like that, investors actually run away, and people actually tend to not be laughing that currency at all. So anytime we see a political unrest, anytime we see something like that, you know, those are the things that you can see on the news, you know, political unrest, those things are about the politics. Those are the things. If there is something banned on the politics, actually on the certain news, you know, when there is political unrest, actually there is something like demonstrations, there is some wars, there is all those things, banned things happen to that nation, and they actually tend to bring something banned on that nation. And that's why we have this can make actually the strength of currency to weaken over here. In case there is a political unrest, it can just cause something like that. That is what you have to know about the politics, how they can just cause like that. Or maybe some politician is just throwing someone that are negative, and they can just cause some people to have bad sentiments on the currency pairs, the currency, and a lot of things that actually can cause the economy to deteriorate right over there. So the other thing when you come to geopolitical event over here is something like conflict. When we have conflict, or you can just call them war. Okay, for example, let's say there's a nuclear bomb that has been thrown to a certain country. So what do you expect over there? A nuclear bomb just being thrown to a certain country, then you expect something like economy to be going down, something like that. The economy to go down. The war is continuing right over there. So a lot of things are going to be going down over there. Let's take an example like Ukraine. So on the Ukraine right over there, Ukraine, maybe there's a bomb that has been thrown in the US. God forbid, I don't people in the US, sorry. But let's say there's a bomb that has been thrown to US. We say in the US, the one that you're going to be using as an example. What do you expect to be happening over there? Okay, a lot of negative impact on their currency is actually going to be happening right over there. So as a trader, anytime you just hear those things, you have to be attentive on the pairs that you trade. Because, for example, if you trade gold, you know what can just happen. People can dump this and maybe buy something else, you know. Yeah, so those are the things that you have to know. Conflict and war, this brings negative impact to the currency. So I think that is simple for you even to understand. The other thing that can cause is what we call the natural disaster. You know, natural disaster, we have something like the earthquakes, fire, you know, all those things can cause the currency to weaken. All those are negative things that causes a negative impact to the currency. Those are natural disaster. So those can cause the negative impact towards the currency pair. The other thing that we're just going to be talking about over here is what we call the trend development, and is that number 3, trend development. So all these things you have to know them. And when we talk about the trend development, then we just be talking the last one, which is the monetary policy, actually where we just end up to, sometimes when you can see something like natural disaster, when you see political unrest, sometimes government can come with policies that does not favor businesses, and that's why you can we have a lot of things bringing negative impact to the currency. Now let's talk about the trend development. And actually trend development is the agreement between the two countries. So between those two countries, we can have trend between two countries. There is something that happened negatively between those two countries, and that is where we can have difference. For example, some countries actually can maybe bring something that is not going, like for example the way you see something on the Russia, okay, they bring sanctions, maybe they don't want to import their oil, things like that. There was something like that product, they refuse something like export. Here we are talking about the import and export, okay, and that agreement maybe is just a cut off. As a trader, you have to be following such things to know what has just happened in that thing. You can just hear something, for example, on the oil side, okay, on the demand of that oil. For example, there is something we were following. Let's just come back over here, like COVID-19. When there was COVID-19, that is going back to the geopolitical event, like COVID-19, when it just came, the demand for the oil actually just went down because there was no movement. The movement was not there. So if there was no movement, so you expect actually the price of something to be coming down. What if we trend mask? What if we trend the mask that we used to wear like this? So what do you expect? We expecting the price of the mask to rise higher. Why? Because there was demand, because there was a very high demand. So that's how you can just be following up these things to know how they just perform over here. Trend development, these are things that actually happens between the countries, and that is what we call, this actually lies more on politics. These are very inside things that you can actually be following up to know what has been happening to them. Now number 4, so we don't have a lot of things to talk on trend development. I don't want you to get confused over there. Number 4, which is our monetary policy. This is the last thing that actually you can just check over there, okay? Now look at this. Monetary policy actually can just come after all these things. Economic indicators, after maybe we have identified something, then monetary policy is actually the decision that either Fed, the Bank of England, the Central Bank of England that comes with it, to regulate, so that they can the currency cannot just lose value, just like to regulate the economy. No, that is what we call the monetary policy. Monetary policy. And that's why we are here. We talked about the interest rate, open market operations, and all those things. So monetary policy is the last thing that actually even the government, or not the government, but the respective bank, those who are on the top there, they can just come up with, like for example in the US, we have the Powell, who is the president there, and they can just come up with things that are going to be on the central bank to regulate the economy. Yeah, so those are the ones that we call the monetary policy, okay? So we have something like open market operation, we have the discount rate, those are things, okay? Public service announcement, and those are the things that you have to actually to know right over there. Like When you talk about the open market operations, this is buying the securities, interest rate. When the inflation comes up, what they do is they increase the interest rate to regulate the inflation. When the inflation comes down, when the economy actually contrasts, what they do is that they cut off the interest rate so that to expand the economy. So that is what we call the monetary policy. Monetary policy. And the 5 thing that you have to be checking, this is a bonus, is what we call the speeches. These are speeches that are offered by these people of the major countries that we trend. We have US, British over here, Bank of England, Japan, Bank of Japan there. Okay, when these guys come over here, then you can be listening to them when they come up with these speeches. The reason being is that you can actually come with something we call them. We can just come up with the point over there, and not so many people actually follow this, but if you are good enough on these things, you can just be following up to know what is just opening right over there. For example, there's some data that have been released on the CPI. Sometimes you can see like the poll coming to speak right over there, and the point that we can just expect over there mostly is to see whether we are going to be having more hawkish on to wish right over there. Okay, so that means, are we expecting to have more interest rate being raised or more interest rate being cut off? And the market actually tends to be very volatile when they are actually speaking. So those are the things that you have actually to be checking on the news. That's just a summary of it. 1 hour 40-minute class. I hope maybe you have got something right over here. If you have any question, very amazing class. If you have any question, make sure that you can leave it in the comment section. We'll just be checking on it over there. Make sure that if you love my content over there, make sure that you actually subscribe right over there. So it is nice to have heard you from the start up to this place. I hope maybe you have understood something that is going to be helping you so much over there. Sometimes I'm just be coming up to Forex calendar, and when we can just discuss everything that is there, how you can just implement them, you can practice and know what is just happening over there, and it's just going to be helping you so much. My name is Dan, so see you next time. Make sure that you subscribe. Peace. Bye bye.